Hi, thanks for joining us here in Crypto Mundial. We just had the FOMC meeting, and I'm going to go over some of the details. And there was some bearish aspects to the meeting. There was some bullish, but there was a lot of bearish aspects to the meeting. So we're going to go over the meeting, and we're going to go over some key points that I took based on Powell's response to the questions after the meeting, right? So let's get to it. So here we're going to click on the projection materials here, right? And so, spoiler alert, right? There was no increase interest rates for the month of June, right? But he did indicate, and you can see here in the dot plot, a 5.6 Fed funds rate by the end of 2023, which is an increase, right? A half a percentage point from where we were in March, in the March projections, right? So this indicates that the Fed anticipates 2.25% rate hikes between now and December. Now, again, they said that they're very data dependent. So it's gonna, it's a wait and see. They're gonna take their time. They're gonna take a look at the data. But from what their expectations are, there's gonna be a 0.5 increase from here to there. So what does that mean? That means no Fed cuts this year are anticipated, right? If you take a look here at this dot plot here, right? So here it could indicate that, there was a lot of alignment from the members in the Fed team with regards to where they will land on the Fed fund rate, right? So there's a lot of alignment there at this point. So, not too much variance. There are some that are underneath, some that want, even more rate increases, but their anticipation is this 5.6, right? We also saw an increase, actually a decrease in the unemployment rate, which was actually a positive thing, right? So they initially in March, their March projection showed a 4.5% unemployment rate. Now they're anticipating at the end of the year 4.1%. There was also a pretty big increase in the GDP from 0.4 to 0.1. This is still pretty low, but it's moving in the direction where they don't anticipate a recession, right? And recession means 2 quarters of negative GDP, right? So this is moving away from a recession, at least for this year. And Fed did mention in the meeting that his base case was not a strong recession, maybe a very mild one, but not a strong recession, right? So these are the summaries here, right? But what I want to do now is, we take some notes here on exactly what he said. There were some questions that were given to him, and he responded to those questions. And I just want to go over them and give you my thoughts on his responses, right? So the first thing that he said, which is very important, was that inflation expectations remain anchored. And if you follow him from meeting to meeting, you know that he's always focused on this. He's very concerned, and he always pays attention to whether or not the expectations of inflation within the U.S. are they anchored? Meaning, do people expect inflation to go back down to their projected 2%? It's very important that this doesn't get to the point where it's expected that inflation is going to stay high, right? So it's very important that this remains anchored, right? The inflation expectations, right? Number two, so this was bullish in my view, right? Of that. Number two that I have here is anticipates rate hikes by the end of the year. Like I said, based on the dot plot, it looks like there's 2 rate hikes that are anticipated. Fed fund rate is 5.6, right? Is the increase from 5.1. So this was actually pretty bearish. No rate cuts by the end of the year, right? So obviously from the 5.6 at the end of the year, that indicates that the Fed does not anticipate any rate cuts at all from now until the end of the year, right? Now, again, he said this could change, right? They take a data-driven approach, month by month, right? But right now, what their expectation is that the Fed rate will be 5.6%. He also mentioned that he sees slower disinflation from what was expected, right? So there is some disinflation. He specifically mentioned core inflation, right? It's very sticky, right? So we have seen it go down based on the CPI and the PPI numbers, but as of from January until now, it's been very sticky, right? The downward shift has been very minimal, and because of that, I think that's leading him to indicate that more rate hikes are yet to come, right? So that was bearish as well. He sees loosening labor market condition. So that is bullish, number 5, but there was a follow-up to that to number 6, right? But he did see that the market conditions have been loosening somewhat. in the U.S. He did, if you follow him, he's always, this is one of the key points that he makes, right? Market conditions are too tight, market conditions are too tight. So inflation is going to remain high, so we need to keep raising interest rates, right? So he did acknowledge that, there is some loosening in market condition, right? So that's bullish. But then he mentions that, it's just not enough, right? So in order for inflation to go down to the targeted 2%, he does envision needing to have market conditions loosen even more, right? So this is bearish. We're not there yet with market conditions. So that was a bearish statement that he made. Someone asked if there was sufficient restrictive rate. If we were at a rate, the Fed rate was sufficiently high enough to be sufficiently restrictive. In the past, he had indicated that he had gotten there with this, but he pushed back. He pushed back on that today. Not pushed back, but he kind of alluded to we're not there yet, right? So it's yet to come, I think were his words. So we're not there. So what does that mean? That means more rate hikes need to come in order for there to be Fed rate, interest rate that is sufficiently restrictive, right? So again, that was pretty bearish. He mentioned that the July meeting is live, right? Quote unquote live. What does this mean? This means that he's telling everyone that although you see the dot plot, although you see that the two rate hikes are anticipated as being needed, that they are data dependent, and that the July meeting, nothing has been decided just yet, right? The July meeting is live. They're gonna go there with new, fresh data, and all the data that's been collected up to that point, right? Especially now that they did not increase this month interest rate. They're gonna see the data, the impact that the previous rate hikes have had, and it's gonna be a live meeting. They're gonna make decisions there as to whether or not there's gonna be a rate increase, right? So that's bullish, because if you look at the two rate hikes that are anticipated, at least they're saying that they're going to be data dependent, and in July they're going to take a fresh look. There's not going to be like, oh, because of this, we're going to have to increase interest rates, right? So to me, that was kind of bullish. He indicated that there is a high level of reverse for TGA refill. There's a lot of concerns about liquidity in the market now that the Treasury is going to have to take some liquidity out, right? Because they're going to need to get some money, right, to refill now that they've signed the debt limit was signed off, right? So, and there's a lot of concerns about the liquidity in the market. He did mention that there was enough liquidity for the refill, right? So, and also I think Janet Yellen yesterday had a meeting discussing this, and that she's very attuned and not concerned, but that she's working with the companies, making sure that there's no negative impact to what the Treasury is going to be doing now by removing some of the liquidity, right? So there seems to be plenty there. So I think that was kind of bullish. I don't know if I believe it or not, right? So in the past, that's been it's been an issue with that, and it's caused markets to dip quite a bit, right? So, but if you take him by his word, then that was pretty bullish, right? Okay. Backed away from housing being very critical for lowering inflation, right? This is number 10. Now, in the past, we've mentioned, the housing market is very hot, and that's one of their key points with raising interest rates. Here he kind of backed out of that a little bit. He mentioned, it's important, but it's just one data point, and he kind of lowered the importance of that, right? Which is good, right? Because we seem to have the housing market pretty sticky, right? We've had a hard time getting that to come down, and it looks like there's some indication that it may not come down for some time, right? So it's good that he backed away from that, from the importance of that. So that was kind of bullish. He also mentioned with regards to recession, there was a question about recession. Is his base case? Is he a recession in the future? Is that needed? He said that that's not his base case, right? He said that before in the past, right? But he does see a path to a soft landing, maybe a slight recession where the GDP goes down below the zero into negative territory. But he doesn't see a hard recession at all, especially now given that how resilient the job market has been, right? So that was bullish, right? So another interesting thing that he mentioned was he needs to keep real interest rates constant, right? So what does this mean? That means that the Fed is raising interest rates, right? And there's an inflation aspect, right? So try to lower the inflation, right? So there's an inflation rate, there's the Fed interest rate, right? So in the future, right, when we start seeing that inflation is controlled and that inflation is going down, right? So the real interest rate, the rate difference between the Fed rate and inflation rate, that needs to stay constant. So as inflation goes down, hopefully, next year, right, we start seeing inflation go down, that yes, he will be lowering interest rates to help keep that gap, from widening, right? So keep that constant, right? The real interest rate, keep it constant, right? So I think that was bullish, especially if we do start seeing interest rates head down later on this year, right? And then he also there was a question about the bank risk, right? So we had some bank failures. We know the government has put some programs in place to help the banks out. So he didn't give a clear answer on this with regards to the bank risks. Is there a big risk of while he raises interest rates or keeps interest rates high? If there's a big risk with banks and how he's looking into that, but he did mention that the Fed does take this into account, right? So he does take this into account, and this is a key decision point of whether or not they raise interest rates. Now, how do they take that into account? I'm not sure. I don't know what data points they look at. I don't know what they do, right? Especially since we did have some bank failures while he was raising interest rates, right? So anyway, this is the summary that I have. Again, there was some bullish aspects, and although you see a lot of bullish items here, I think overall the weight of this was pretty bearish. Just the fact that they went from the 5.1 to the 5.6 fund rate, right? So that just means there's 2 more interest rates coming. They anticipate by December. And also, there's no Fed cut, right? So before, if you look at the CME watch tool, there was some indication that by December, the Fed was going to cut interest rates. Now, if you look at this, it's shifted quite a bit, right? So it shifted to them being less than 5%, right, which was the majority. Now you see that the majority indicate that it's going to actually be at least 1 more rate hike by December, right? And no rate cut, it seems like. So yeah, so that's the summary of that. The impact, if you look at BTC right now, Bitcoin, pretty negative impact on this, right? So this is the effect of the Fed meeting today, right? So we'll take a look at this. The positive is that we did have some good PPI numbers. CPI came in good, right? Yesterday, PPI came in pretty good today. So we have pretty good numbers there. So, and there is more data points to come before the next Fed meeting. So we'll keep a close eye on that. We'll see if maybe this was his way of just calming the markets down, right? And maybe they really don't anticipate these increases if we keep on the same track of lowering inflation, right? So stay tuned. We'll give you more updates as they come along. We're going to have similar response to this in Spanish. So if you want to look at it, see this video in Spanish, then please look at the link below. We'll have that there. Have a good day. Take care.